Hello everyone. Today we're going to be looking at how to calculate an amortization table using Excel. Okay, why would we want to do that? There's a couple reasons. You may want to see what your monthly payment is going to be like on a loan by changing different inputs like the length of the loan, the interest rate you're going to pay, and maybe a down payment you would bring to lower the loan amount. You may also want to see how much of your monthly payment is going to be going to interest versus the principal, the amount you owe throughout the life of the loan. This is exactly the kind of math that they use at car dealerships when you go in and try to get a loan for a car, and when you go to apply for a loan to a bank for a mortgage. It's the exact same kind of math. They're doing this exact same thing. So it's useful going into those situations to do the math ahead of time and figure out exactly what to expect when you get into those situations. As a reminder before we get started, if you are a Patreon member, you can just download this file directly. So if you just want to sort of skip ahead and just get the final download, head to the link in the description and you can download it directly. With that, we will get started here. You can see already I put a few inputs up above. We'll fill those out together, but just to save time on typing here, I put in some of the inputs we'll need to get going here. We're going to start by doing a 30-year mortgage amortization. So this is very typical and where you would probably most often see an amortization table like this. So let's start with our inputs. Let's, for example, assume we are going to purchase a house. In this case, our house is going to cost $500,000. So I'm going to put that in here. And as always, you will bring a down payment when you're looking to purchase a home. And so in this case, we're going to assume it's a 20% down payment, and we're going to enter that as a negative number. And so we're going to do negative 100,000. And the reason we do that is just because it's reducing the amount of the loan. And so we're going to enter it as a negative number. And so with that, the amount we are actually borrowing is only 400,000. And so when we're calculating this amortization table, the only thing being amortized, which just means being paid down, is the amount of the mortgage. So in this case, it is $400,000. A couple inputs we'll need here down below. The interest rate we're going to pay on the mortgage. For now, I'm going to put 7% as a 30-year mortgage amount. And then the loan length. How long is the loan? So you can see here I've already identified we're going to enter this as months. And so in a typical 30-year mortgage, we are going to have 360 months. I'm just going to enter this as 30 years times 12 months per year for 360 months. All right, next is what is our monthly payment amount? This is a calculation we're going to do. And so we can go ahead and use Excel's payment function. So if you just do equals PMT, it will bring up the PMT formula, which is just a way to calculate the payment amount. There are a couple inputs we need. The first is rate. So for rate, what they mean is your interest rate. And so we're going to go ahead and select the 7% above. But we need to remember that this is an annual interest rate, and we're going to pay our mortgage on a monthly basis. So we're going to take that 7% rate and we're going to divide by 12 just to turn it into a monthly rate. The next input we need is number of payments. That's that NPER. We already have the 360 up above, so we're going to select that. Next one is PV. That just means what is the current value or the present value of the loan amount. So we're going to select this 400,000 up here because that is the amount we are borrowing. And then FV, we'll see here, is future value. That means how much will the loan be worth at the end of the term. And since we're going to pay it down over our 30 years, we can go ahead and enter 0 here. And so with that, you will get a monthly payment amount. And so in this example, the monthly payment amount would be $2,661.21. So we're going to use that throughout the rest of the calculation here. I'm going to go ahead and set this up the way I like to do this, and you follow along. I'm going to enter in the headers of the table first, and then we'll dig into the actual calculations. Okay, so first we're going to enter the month number because we're going to need to do this for the 360 months. And so we're going to go 1 through 160 here, but I promise it'll be quick. Next is beginning balance. And I'm just going to correct all my spelling here. And the monthly payment. And interest paid. We'll see how we're going to use all of these in just a second. Principal paid. And then the ending balance. Okay. All right. And for each month, we're going to start the table here, and we're going to go month 1, month 2. Don't do this all by hand. We'll just drag this down. We know we're going to need 360 months, so I'm just going to drag this all the way down to 360. Keep going, almost there. Okay, month 360. We're going to do the first month together, and then we can just sort of drag everything down. Okay, so in month 1, your beginning balance is the amount you've borrowed. And so we're going to just link directly up here for month 1. Our monthly payment amount is what we calculated in cell D9 with our payment function. And our monthly payment is not going to change throughout the term of the loan. So I'm just going to go ahead and lock that because it's going to be the same every single month. Okay, for interest paid, we do a quick calculation. We're going to take the balance of the loan at the beginning of the month, and then we're going to multiply by our interest rate. And again, you can go ahead and lock that cell because the interest rate is going to be the same throughout the duration of the loan. And then we're going to divide by 12 because, again, that is an annual interest rate. And so to get a monthly rate, we just need to divide by 12. I'm also going to make this a negative number just so it is consistent with the monthly payment to the left. So in this example, our interest paid is going to be $2,333.33 in the first month. For this principal paid column, we just need to back into it. Essentially, we're going to pay this $2,600 of monthly payment minus the interest that's paid. And so in this month 1, there's $327.88 going towards the balance of the loan. And so by the end of the month, once you've made that payment, I started with $400,000, and then I paid off $327.88. So my ending balance was $399,672.12. And so all we need to do at this point is just carry everything down. And so your beginning balance in month 2 is the same as your ending balance in month 1. So you can just link directly there, and that'll be the same in every single month. It's just going to carry over from the prior month. For monthly payment, this doesn't change, so we're just going to drag that down. Your interest paid is going to be the same calculation, but you'll see the value will change a little bit. And the same with your principal paid and your ending balance. And so what's happening here is your monthly payment is the same every single month, right? Your mortgage doesn't change unless you refinance it or something. It doesn't really change every single month. It's the same exact amount. What's changing is how much is interest and how much is principal each month. And so you can see just going from month 1 to month 2, our interest amount went down just by a few dollars and our principal amount went up. We paid down just a little bit more principal in month 2 versus month 1. All right, then what we can do is just drag this month 2 down to the very end, down to month 360. And what we'll see at the end here is that by the end of the 360 months, we've paid down the loan. What's happening is the interest has gone to being, the payment has gone from being almost entirely interest to almost entirely principal. So as you pay your mortgage off, again, the payment stays the same, but because the balance is being paid down a little bit each month, you're paying less interest as part of that payment, and more of it is becoming principal. So now you're done. You've got your whole amortization table here. By month 360, the loan has been completely paid off, which is great. That's a good check. And then what you can do is you can test out different assumptions. Maybe you think you can get a little bit better interest rate. So you're going to go 6.5. That adjusts your payment amount. Again, the payment amount stays the same throughout the course of the loan, but your interest and principal calculations change a little bit because now you're paying less interest and you're paying a little bit more against principal each month. You could change, hey, what if I bring a bigger down payment and I can bring $150,000? That changes your beginning balance here. It's still going to amortize over the course of 360 months, but your monthly payment is lower because you brought a little bit more to the down payment and reduced the amount you're borrowing. So that's a quick example of a 30-year mortgage. You can do the same thing with a 15-year or a 5-year. Just for example, we can do a 5-year real quick just to show how that dynamic changes. And so in this case, I just duplicated that sheet. And then what I'm going to do is instead of 30 years, it's only 5 years. And so it's a 60-month loan. And of course, you don't really have mortgages over 5 years. This would be like a car loan example. And so maybe we say you want to buy a $25,000 car and you're going to bring $5,000. So the loan amount would be $20,000. Maybe in this case, you feel like you can get a 5% interest rate. So then your monthly payment would be $377. From our mortgage example, we had 360 months. So we can just delete everything after month 60. We don't need it because this is a 60-month loan. And so the same dynamic is at play. By the end of the 60 months, we've paid down the entire balance. And the principal we're paying increases as we go through the term of the loan because, again, we're paying less interest because the balance is decreasing throughout the loan. So those are a couple quick examples. Hopefully that gives you the tools you need to do, a 15-year mortgage or maybe you have a 7-year car loan, whatever the example is. You can change all of the inputs here: purchase price, down payment, the length of the loan, and you can just build your own and build it in such a way that makes sense to you. But this is the math and this is the starting point. That's all I've got for today. Thank you for watching. Please like and subscribe the video, and if you want the file directly, consider becoming a Patreon member to support the channel. All right. Thank you so much. Bye-bye.